Hi everyone, welcome to our 12-part series, Inside the One Big Beautiful Bill Act. I'm Kenny Birch, a tax director in our mortgage banking tax practice. And throughout this series, we're breaking down the most important tax changes under OB3 and what they mean for you. These updates can have a real impact on planning, compliance, and your bottom line. So if you want to stay ahead and make informed decisions, you're in the right place. Let's take a look at the SALT cap and pass-through entity tax deductions and why these matter for planning with Jeff Lloyd. So Jeff, what is the SALT deduction?
Hey Kenny, thanks for having me. The SALT deduction is the amount of state and local income tax, property tax, and/or sales and use tax that an individual can deduct on Schedule A if they itemize deductions on their personal return. SALT taxes include income taxes withheld from wages, estimated taxes paid, property taxes on real estate, and annual taxes based on the value of personal property, such as cars and boats. Also, some individuals may elect to deduct sales tax instead of income tax if their state has no income tax or a low income tax rate. However, the TCJA created a new limitation on the amount of this deduction, significantly reducing the benefit this deduction has for taxpayers, especially high net worth taxpayers.
Thanks, Jeff. That's great. Can you tell us a little bit more about what the pass-through entity tax deductions are?
Yeah, sure. The pass-through entity tax deduction, or PTET for short, refers to a workaround to the SALT deduction limitation. Most states at this point have implemented PTET returns that allow the pass-through entity to elect to pay taxes on behalf of its owners. This works by allowing the entity to take the deduction on page 1 of their tax return, which then reduces federal income, and then that income flows through to the owners on their K-1s. Since it is reflected in their taxable income on their K-1, the owners do not need to use Schedule A to then claim those deductions for the taxes paid, thereby avoiding the limitation.
Okay, thanks, Jeff. Next, maybe what do lenders need to know about these topics?
Yeah, as mortgage companies get back into taxable income, the types of tax returns that get filed will affect the amount of taxes that will be deductible on their owners' personal tax returns. It's important to make sure that proper planning is done, especially by the original due date of the returns, to ensure that elections are in place by the correct time to lock in deductions, as well as make any relevant payments.
Thanks, Jeff. That's great to know and appreciate that. Can you tell us what the SALT limitation is now and what it will be under OB3?
Yeah, absolutely. Before OB3, the SALT limitation was $10,000. Starting in 2025, the limitation is temporarily increased to $40,000 for single and married couples filing jointly, or $20,000 for married filing separately. There will be a 1% increase from 2026 to 2029, with the limitation reverting back to $10,000 in 2030. There is also a phase out that begins at modified adjusted gross income of $500,000, but the deduction would not be reduced below $10,000. For example, let's assume a taxpayer has $40,000 of SALT tax to deduct on Schedule A. If the taxpayer's modified AGI is $550,000, the allowable SALT deduction is phased out at a rate of 30% for income above $500,000. So in this example, the taxpayer's SALT deduction limitation would be reduced by $15,000, which is that $50,000 excess AGI at the 30% rate. And then ultimately they would be able to deduct up to $25,000. Once a taxpayer's modified AGI is $600,000, they will be fully phased out to the $10,000 limitation minimum. However, I will note that beginning in tax year 2026, itemized deductions will now be subject to an overall limitation that we're going to cover in more detail in another episode. But the base amount of that SALT deduction would not be reduced below $10,000.
Thanks, Jeff. Can you tell us a little bit about what lenders need to do because of these changes?
Yeah, that's a great question. Before the OB3 was finalized, there was some talk about implementing rules that would disallow the SALT limitation workaround. But in the final bill, fortunately, there are no limitations to PTET deductions. Yeah, so lenders will want to discuss the increased SALT limitation and pass-through entity tax return options with their tax advisor. They can help determine what returns will be most beneficial for the company and the owners to file, and ensure that timely elections are made to be able to utilize the PTET deductions.
Awesome. Well, Jeff, thank you for explaining the SALT cap and PTET changes. For more OB3 updates, please browse through the other videos in this series.